Cost of living pressures continue to build, but the jobs market is as strong as ever. Our latest thoughts on the economic outlook here and abroad after the recent RBA rate hike. The Reserve Bank's third successive 0.5% rate rise in August confirms they are on track to get the official cash rate back to neutral by year end. And recent RBA speeches suggest that neutral is somewhere between 2.5% and 3.5%. Whether they pause at neutral or feel the need to move to more restrictive policy settings is one of the key unknowns, along with how quickly supply-side issues and the much higher energy costs can normalise, plus how our economy will cope with around 3% of rate hikes in under a year. The latest increase in the cash rate up to 1.85% we expect will probably be followed with 3 more over the next few months, likely to be smaller increments of only 0.25%, taking us to just below 3% by year end. As the chart shows, we are now back at 2016 levels for cash, but real rates, taking core inflation into account, are still negative, and the latest CPI report and associated forecasts from Treasury suggest inflation will be above the RBA target for at least another year. The Reserve Bank will publish a full set of economic forecasts on Friday in their quarterly statement, but ahead of that have already updated their forecasts for CPI to still be up at 4% at the end of 2023, and for GDP growth to slow to only 1.75% next year and again in 2024. So, while there is some market commentary that the RBA may be cutting rates next year, a more plausible scenario is a plateau in rates at about 3% rather than a peak, given the new world of higher inflation and also the strong jobs market. Our unemployment rate is down to a 48-year low of 3.5%, and total employment up to a record high of 13.6 million, which, as the chart shows, is inconsistent with what we would normally see in a recession. So assuming demand for labour remains strong, helped by the government supporting businesses by accelerating net migration and skilled labour to Australia, this should see a soft landing for the economy, albeit one with a much slower growth rate next year, and, as we mentioned last month, unemployment slightly higher next year at 4%. The geopolitical backdrop is as challenging as ever, and while our economy will decelerate, many others around the world will go into reverse under the pressure of the global energy and inflation shock. So the outlook here is one of outperformance, but households and businesses challenged by higher costs and less demand from overseas. Fortunately, the latest data shows that household savings are still near record highs. So these buffers that have been accumulated during the pandemic will be needed to deal with higher interest rates and inflated costs of goods and services. Higher interest rates are an immediate issue for those with a variable rate mortgage, but everyone is being impacted by the global inflation surge. And lastly, property values continue to ease in capital cities as interest rates rise, while regional property is proving more resilient. But all asset values will adjust to a cash rate around 3% above its pandemic emergency setting, so we still expect a 10 to 15% decline for houses from peak to trough before the next upswing. The difference ahead, though, may well lie in a more stubborn core inflation rate. So as the latest Productivity Commission report argues, the economy needs a sharper policy focus on productivity measures to sustainably lift real wages and prosperity. And that's the market update from Leveraged.